Hello and welcome to the Al-Attiyah Foundation podcast. My name is Naweed Jabarkil. It gives me great pleasure to welcome Mr. Joel Couse to the program. Mr. Couse is a special advisor to the International Energy Agency, commonly referred to as the IEA, specialising in energy markets and security. Previously, he was Chief Energy Economist for Total Energy. Joel Couse, welcome to the Al-Attiyah Foundation podcast.
Thanks, Naweed. I'm delighted to join you today for the podcast, and I'm looking forward to this discussion.
Let's start then with your role at the IEA. Just tell our listeners a bit about what the IEA is focusing on. Some say it was established as a body to oppose OPEC.
Well, the IEA is at the heart of a global dialogue on energy. And for example, Fatih Birol, the executive director of the International Energy Agency, was at the G7 summit, Leaders Summit in Tokyo this past weekend, in Hiroshima this past weekend. It's the analysis of data and policy recommendations that are done by the IEA that helps countries develop their own secure, sustainable energy supplies for the longer term. The IEA was created in 1974 to help coordinate a collective response to major disruptions in oil supply. This is not in opposition to OPEC, and the IEA has cooperated regularly with the organization during past periods of disruption. And a good example is what was done between the IEA, the G20, and OPEC in April and May 2020 to try and help stabilize the market. Oil security remains a key aspect of the IEA's work that has expanded significantly now to cover other energies like gas, obviously, given the crisis that we've just gone through, but also things like critical minerals and grid design for supporting the development of renewables. The IEA recommends on policies to enhance reliability, the affordability, and the sustainability of energies. And it takes an all energies, all fuels, and all technologies approach. And it examines the different questions concerning these technologies from a supply-demand perspective, looking at energy efficiency, demand-side management, the technologies, the electricity systems, access to energy, etc. And since 2015, the IEA has opened up to emerging markets in order to expand its global impact and deepen its cooperation.
And looking at oil markets then, a lot of the thought at the moment is that demand relies largely on China and India, those two economies. Is it as simple as that, do you think, or is the real picture much more complex?
Well, oil demand is really driven by the economic well-being of the world's populations. As the economic well-being improves, and China and India are good examples of that, that drives increasing demand for oil. The recent recoveries in China and India have certainly helped to boost oil demand in 2022 and 2023. And this year it will reach its highest level ever. Notably in the fourth quarter will be over 102 million barrels a day. And the strong rebound in air travel worldwide that we've seen since the reopening of China in December last year will account for fully 50% of the growth in oil demand this year. So that's complemented by expanding petrochemical activity that is helping to provide a boost to overall demand. On the other hand, there are a number of factors that are helping to slow the growth in oil demand, particularly in transport fuel demand. Average fuel efficiency for the different vehicle fleets has improved. Electric vehicle penetration has vastly accelerated across the OECD and China. Uptake of biofuels continues to expand. All these factors have flattened growth in gasoline and diesel demand for cars. And that will contribute progressively to a peak in road transport fuel demand sometime in the next 2 to 5 years.
And looking at the supply side of things, India, China, both big buyers of Russian oil at the moment. The markets seem to have adapted somewhat to what's happened in Ukraine over the past year or so. Also, the embargoes imposed by European nations on Russian oil and gas. But shipping costs have increased, and Russia has discounted prices to try and secure markets in places like China and India. Is that a fair summary of recent events, do you think?
Yeah, that covers it. It's oil markets have really adapted better and probably faster than many expected to the embargoes and restrictions that were imposed on Russia. Russian oil has continued to flow very smoothly to the markets. Crude and products has shifted away from the EU and G7 destinations where it was going prior to the invasion of Ukraine, and it's now going to other buyers that are motivated by the large price discounts that they can get on the Russian oil. The FOB, the free on board lifting prices for Russian oil have on average been below the G7 price caps for crude and products since December and February this year, with the exception of April when crude was 12 cents above the price cap. But the changes in flows have certainly driven increases in tanker freight rates. Russian oil travels further, while EU and G7 supply comes from more remote locations. This has locked up a lot more tankers. On the other hand, the costs have eased somewhat as new tankers have been delivered into service over the course of 2022 and 2023. And many of the older tankers are no longer retiring, but are operating as part of the shadow fleet that is transporting the sanctioned barrels for Russia, for Iran, and for Venezuela.
And zooming out a little bit and looking at demand, perhaps more long term, electric vehicles are one major factor that's weighing on a lot of people's minds, particularly the rise in sales in the European Union, for example, and China as well. Do you think it's going to lead to a worldwide reduction in demand for gasoline moving forward?
Yeah, I think we definitely see that happening. The acceleration in sales is really astonishing in the last 2 to 3 years. And we're now reaching sales that represent between 5 and 10% of worldwide sales, much higher, obviously, in Europe or the US and in China. And that penetration is clearly having an impact on gasoline demand. We see growth in gasoline demand this year, but much of that growth is driven by China coming out of COVID, by what's happening in India, but in the OECD, it's flattening out very clearly, and the EV fleet will contribute to a peaking in gasoline demand sometime in the next 2 to 5 years.
Looking at what OPEC Plus and other alliances producers are doing, they seem to be taking a more aggressive stance in terms of protecting their interests over the past 18 months or so. Does that pose a threat, do you think, or is it fully understandable?
No, that in some ways it's understandable, and we've seen their desire to avoid another collapse in prices like we saw back in 2020, which had really quite a brutal effect on those countries and was destabilizing in many ways. So their efforts to ensure that the market remains balanced in the face of uncertain oil demand trends is understandable. The concern that the IEA has on that account is that it at this point in time, with the rapid increase in other costs for consumers, sustaining above average oil costs is challenging for those consumers. That's understandable. The other concern that we have is the need to allow a rebuilding overall of oil stocks, which are essential to confronting, as the IEA is logically concerned about, that's part of their mandate, is confronting disruptions in oil supply when it comes, if they come.
And picking up on that point, a lot of these economies, countries, governments are focused on diversifying their economies. The thing that's looming over all of those is the idea of peak oil. When do you think we'll see it, or has it already happened?
Well, the IEA's scenarios see a peak or a plateau in oil demand by around the turn of the century, and that's in the World Energy Outlook STEP scenario, which is the scenario that's closest to a business as usual scenario. Beyond that, the more aggressive scenarios from an energy transition point of view see an earlier peak than that. So yeah, it's coming, but when we see it as a peak or a plateau, that means that there's many years of oil demand ahead of the market.
And looking at how companies are responding then, do you think there's sufficient investment in, say, upstream production at the moment to balance the supply with demand moving forward?
That's a very good question. One of the real issues today is cost inflation in the energy services sector. And cost inflation has limited the impact in developing the capacity, despite the fact that the oil industry continues to invest substantially. The oil services industry's capacities are limited in some sectors. And as a consequence, I think if the oil industry threw more money at developing oil and gas reserves, it might simply aggravate inflation today. So as those cost constraints ease, I think each dollar invested will probably do a lot more. So at this time, the IEA scenarios don't see a near-term issue in terms of cost constraints if the cost constraints drop and if investment budgets remain sustained at current levels.
And US production is one factor that's really been exceptional in the last year, last decade rather, in terms of changing markets. We're seeing some problems there over in the States. The Permian field, for example, in the southwest of the country, it's hit a production plateau. If there is a need for more demand there, where do you think additional supply will come from? Will it be a matter of looking back towards Middle Eastern producers?
Well, if we look at the U.S., it's a phenomenon it's a treadmill where new wells are constantly needed to offset the steep initial decline curves of the existing wells. So the overall volume production has to eventually reach a point as it grows and grows and grows, where the equilibrium between drilling new wells only just keeps pace with those decline rates. So logically, that will come at some point in time. It's not obvious that we've hit that plateau today. The slower demand growth that the IEA is expecting in the coming years and possibly a plateau by around 2030 will certainly help offset some of the risks related to such a peak in US production. We are seeing substantial growth in production coming out of Latin America, in Guyana, in Brazil. We're seeing steady growth in the Middle East, which is certainly a key factor to offsetting the growth in demand relative to any plateauing in American production. I think the risk in all of this is what's the likely outlook for Russian production in the years to come. Will sanctions have or not have an impact in terms of Russian production and the flows of oil, crude and products out of Russia in the coming years?
And I just wanted to get your thoughts on the Middle East. This region, traditionally a major setter of prices, the financial needs of governments here, seen as low-cost oil producers. Is that still a major factor in setting global oil prices?
Well, yeah, I mean, as we said earlier, OPEC production cuts have helped sustain prices that are around their current levels in recent months. Obviously, the global macroeconomic factors have contributed to much of the uncertainty. There's an entire paper sphere of the oil market that is a major driver in terms of the price perspectives, and we can see that the paper sector is hesitant now, given the macroeconomic uncertainties. There's also the impact of the US dollar exchange rate as the US dollar gets stronger because of the interest rate differentials. But clearly, OPEC remains prominent in setting the price by helping to set the balance in the market.
And there are other potential threats, maybe regulation being one of them. The European Union, it's proposed a carbon border adjustment mechanism at the moment to tax high carbon emission source fuels. Do you think such mechanisms will work practically and politically as well, given the differences and what's involved in terms of implementing them?
Well, the mechanism has been adopted. So it will enter into a first, what they call transition phase in October 2023, after which the markets will begin to determine what's been imported, what's the carbon content that's been imported by the different organizations in order to develop a tracking of the carbon transfers across the European borders. And then in January 2026, it will move to a new phase where taxes will be levied on the carbon volumes being moved into Europe, and the taxes will correspond to the level of the EU ETS carbon tax. So in the meantime, the mechanisms around that have to be sorted out. There's a lot of thinking going into that, and more detail on that will be announced in the coming months before October 2023, so that people know what they're doing with. Obviously, this has garnered a lot of political sensitivity with our trading partners. On the other hand, there's a certain amount of pragmatism that partners are showing, and notably China, in trying to put forward a degree of effort to show that they are trying to reduce the carbon content, their emission content of their own exports to the EU.
And many people would look at some of the results coming out of international oil companies and say perhaps this is a good time to be leading a company in the sector. But if you were thinking like a CEO of a major international firm, what factors do you think would be most important when making upstream oil investments that many see as necessary? I mean, would you, for example, look at rapid payoff projects?
I think CEOs are always looking for the low-hanging fruit, the easy gains. If there's a rapid project, a satellite field to be developed at low cost, that'll pay off in short order, I think they're willing to do that. But I think most CEOs looking for sort of longer-term production profiles, which are necessary to sustain a company's activity, they're looking for fields that have, on the one hand, the lowest possible cost, as well as low emissions. Because as you pointed out with the carbon border adjustment mechanism, they will be looking at what the emissions, the related emissions are for the oil imported into the EU, whether it's for petrochemical uses or continuing production of fuels until however long the EU needs to have those fuels. And that will be an issue for most other countries, and for the reputation of the companies as well. So it's a combination of low cost, low emissions, and that is those are the two top priorities right now.
And just picking up on that, the metrics for a national oil company, perhaps where the thinking needs to be a lot more strategic than just shareholder interest or bottom line, what would be your recommendations there, or what factors would you consider when making oil investments from the perspective of an NOC, particularly with regards to stranded assets and the changes to sustainability?
Well, again, obviously low cost is a priority when we're talking about stranded assets, but also low cost means that the lowest cost producers are going to be the longest in the market as time goes on. But they also have to be low emission producers in order to ensure that they continue to have access to those markets that are concerned about availability of low carbon products, low emission products. I think the projects also have to be scalable. In other words, they look at it and they say, I want to do this in units so that I can keep pace with the evolution in demand. And I think they have to be adapted so that they provide the greatest benefit to the producer countries from an economic and a social point of view.
And just lastly then, obviously sustainability a major issue in the industry, as you've mentioned now. Do you think that there is enough scope perhaps for the sorts of investments required, the type that the IEA says are needed towards renewables, while also meeting the needs of populations and that thirst for electricity or whatever fuel source there is?
I think the IEA has said that we need to invest almost $4 trillion in the energy transition by 2030. At this point, we see about $2 trillion being invested. Clearly, we have to up our game in terms of the amounts invested, and that's all energies and all solutions. So there's a lot of work that has to be done. Part of it is the companies themselves in terms of investing more in the energy transition. but part of it is also from the consumer governments in terms of creating the opportunities to make those investments profitable when they come. I think there's been some terrific work that's been done in the EU, Fit for 55, and the green energy solutions. There's also the the Inflation Reduction Act in the US, which has attracted a huge amount of investment and is creating a lot of emulation from governments around the world. And I think we'll see that bring forward more capital for investment as tax incentives and other measures are provided by governments to attract those investments.
The thoughts of Joel Couse, the Senior Advisor at the International Energy Agency. Joel, thank you very much for your insights into the workings of the IEA and your views, of course, on the future of the oil markets. The Al-Attiyah Foundation very much looks forward to speaking with you again in the future. And thank you all very much for listening. Be sure to keep up to date with all of the Al-Attiyah Foundation's work by following us on Twitter and YouTube.